stock market. The rally is progressing. We hit up to where we thought we could get to fill that gap in the 119, 120 area. We still see the possibility of more rally. We still see an up week this week. Daily stuff is not overbought, and resistance is 120 to 125 still on the spider, with a likely attack of, say, 123 in the cards. We've got some good news as well as some bad news. And the good news is the percent bears number has risen almost a full 10 percentage points to I think it's 33.7. But the main thing is it suddenly has jumped up from the 23 area to the 33 area. That's the sort of thing we want to see, and ideally we'll see those numbers again next week. I would say that if I were a call writer here, based on the action, I would be starting to do some of my call writing today and tomorrow, especially given the premiums and especially given the idea that if this rally is going to do what I think it's going to do, this week will be nicely up, i.e. tomorrow will be up, and then next week will be choppy to down a little bit, and then the third week of this formation would be fairly nicely up. So in other words, going into the week of September 5th, we could see some more advance. Basically then, our plan will be to look to exit trading positions for people and then see if we can get some sort of a retest over the next few weeks. We've had an awful lot of questions given the news on Bank of America, some of the financials and stuff of that nature. Bank of America had a short-term target coming into this morning of 880, which was actually the highs of the move. If we can get through 880 on that, we'll see what happens. But the important thing with the financials is, even though they look like they're bottoming, they still may not outperform. We prefer our sectors of energy, and we prefer our sectors of technology in terms of what's going on. I do want to mention one thing, though, and that is these banks have been trading as if there is a credit crunch on the horizon, and we don't believe there is a U.S. credit crunch on the horizon. Bear markets have a tendency to look through the rearview mirror and think we're going to have the market going down because of the last problems, and we don't think that's the case. Now, obviously, if something in Europe happens, we've got some issues, but we don't think it's going to be a U.S. credit crunch. So the financials are probably overdone on the downside here, but will still probably underperform into the end of the year. Credit crunches, though, do not happen in low-rate environments. They only happen when interest rates are going up. That's a nice lesson from Rich Bernstein that has been sort of pounded home forcefully to me. Let's talk about the bonds for a minute. The TLT model still suggests lower prices into the 100 area on TLT. We admit that this model has not done the best job of forecasting bonds, i.e. bonds have gone way through the highs that we've been forecasting. But given that, the peak in the 110 area looks like bonds should come down, and we're going to look at that very carefully if bonds get down into the 102 area on the TLT. Gold has been an interesting area for us. The GLD hit, the COMEX gold futures hit 1890. GLD only hit 184. The nearby futures have certainly been running more up and down. Given that, they've also come down to our first target of 170 on GLD and are in fact trading below there. Gold is probably a short-term buy-in here to move to a less of an underweight than we've been, but I can still see GLD heading for 161, 162, and if that is the case, that's when we would become an overweight again in gold. But this kind of price action that we're seeing here in GLD is normal for the gold market when you get margin calls and when you get problems in that market because of the nature of margin. I actually spoke to someone yesterday who did not realize that margin in commodities was different, so we'll go into that for just a minute. In the commodity markets, margin is not set by the Federal Reserve as it is in stocks. It is not set by Regulation T or Regulation Q. Instead, it's a good faith deposit on the contract. Generally, that margin initial deposit is only 3 to 5% of the contract. So what that means is people that bought gold in the 180 area have been essentially, their accounts have been wiped out unless they've had, 40, 50% margin in there. And that means there's forced selling going on in gold now. That's probably one of the reasons why it gapped down so much. And again, this is normal, but this market's probably going to have to stabilize. Our new 12-month target is, I believe, 210 on GLD or 2100 an ounce on gold in 12 months, not tomorrow. So, we would accumulate gold in here, and we, of course, look at the miners, GDX, PSAU, ASA, and some of the gold mining stocks, et cetera, as being a way to add money to that area of the market without taking a huge risk.